Morning, Andrew.
Good morning to everybody. So shall I share a little bit about my story?
Yes, that'll be great.
Well, I'm going to share where my story ends. I'm 54 years old. I'm in Bangkok, Thailand, and my mother is 82 years old, and she lives with me here in Bangkok, Thailand. And that's where the story ends. One of the things about my mother that's pretty unique is that somehow, I can't tell you how exactly my mom and dad did it, but they did it. And when my father passed away about 4 years ago, when my mom moved here to Thailand, we went through her account, her investment account, which my dad and I had been working on. But you know, my family was a salary family. My dad worked for DuPont. And when my mom got here, we went through the investment account. I said, Mom, you've done it. You have $1 million worth of assets. You're 80 years old at the time, you know, age 78 when she came here. I said, you're not gonna have to worry about money for the rest of your life. And that is really one of the greatest things I've really experienced, is the freedom and the lack of stress that my mother has at her age. And it wasn't because my parents were rich. In fact, I can remember when I was a young guy rising up in the corporate world very fast, I had to ask my dad for his tax filing for something. And I never knew anything about what my dad made. And when I was, 32, I made more than my dad. And so I basically have seen the success of investing. So that's kind of a story about where I'm at now. But basically, when I was a young guy, I studied finance. I was interested in finance, and I became an analyst in the stock market. And I moved to Thailand. I moved to Thailand in 1992. Can you imagine? I mean, it was a pretty emerging area, and I basically built a career in the stock market here in Thailand. Now, my career has always been taking care of institutional investors, banks, brokers, fund managers, everything on the inside of the investment world. But the story that I have to tell is the story about my nieces. And one of them, when she was 16, asked me, could I get rich in the stock market? And that's really why we're here today, because I needed to help her think about that problem and solve that problem. So maybe that's a little bit of an overview. And then Elizabeth, tell me how that is. And then what direction we should go, and then I'll continue on.
Yes, thank you so much. That's great. So could you now share with us, how did you help your nieces to navigate from age 16, navigate how to get rich in the stock market, and how, and what, maybe start with what exactly is the stock market?
Yeah. Okay. So let's look at that. Now, I had a big problem taking care of my nieces because there was one major barrier. They had no interest in the stock market. They didn't like it. They weren't studying it. They weren't interested. They just were interested in getting rich or, building up some financial freedom. So this became really my big challenge. How do I communicate to them what they need to know about the stock market without bringing them all of the complexity that I knew about the stock market? How could I bring it down? And that's really what I did. And with my first niece, Kristen, I kind of made a lot of notes. I actually made a PowerPoint presentation, and I gave it in Bangkok to a group of people that I said, come to this event. And I did a half-day session presenting this material and then testing it and all that. And then I eventually sat down with Kristen back in the US. She was outside of Boston. So when I went back to see her, I sat down and explained it to her. And then I gave her a gift of $3,000 when she graduated from high school. And I basically helped her to open up an investment account. In this case, it made sense for her to open up an account at a fund management company or mutual fund company. So she opened that account. In this case, it was Vanguard. And then I told her, basically, based upon everything that I told you, here's what you buy. And so she then started to follow that. and then started to build her wealth, you know, by doing that. And so that's kind of the short story of it. And today, I know that a lot of people, I would like to ask a question of all of you. Two things. First thing is, I would love it if you could just, I don't want to be ageist, but I'd love to know your ages. So just throw in 21, 47, just so that I can see kind of roughly what people's ages are, and that will help me. The second thing is, okay, so we got 42, 34, 33. Okay, so 30s, 29, 30. Okay, great. 37, 45, 18. All right. 18. Kenny is 18. All right. He's the youngest so far. We've got 37, 36, 33, 34. All right. Good. Thank you. Now, let me ask you, there's two different types of people out there. There's one type of people like me. I'm crazy about the stock market, investing, finance. In fact, I have a PhD in finance. I spent my whole life in finance. But most people are not like that. So I would like you to tell me if you, yeah, Lady Ebony, I love it, 50s, just like me. Now, I'd like it if you, if you can put into the chat whether you love, like, or hate finance and the stock market. Love, like, or hate. And it doesn't matter. I just want to get a picture of kind of where people are at. All right. We got likes. Yep. Like, love. All right. Yep. Hate. Yes. Don't understand. Okay. Don't understand. Excellent. Yep. Don't know. Right. Like, love, but don't know anything about it. Like-ish. All right. Love, hate. Don't know it that well. Okay. So those are great answers. So that helps me to understand kind of where you're at. So I think the first thing I want to just talk about, and it's a theme that we'll have throughout this whole thing. And I have a podcast, and on the podcast, I always end it with to help us create, grow, and protect. So if you could take a note, create, grow, protect. Just type that in so you don't forget it. Create, comma, grow, comma, protect. This is critical. Now, why do I say this is critical? The most important thing, all right, create, grow, protect. Never forget this. The most important mistake that most people think when they go into the stock market is that they are going to create their wealth in the stock market. That's the number one mistake that people have when they go in the stock market. It's a little bit like going to the casino and saying, I'm going to get rich in the casino. And you've never been. It's just unreasonable and it's strange. So basically, the stock market is a place where we grow our wealth. And that's the key. So that's the first thing that I wanted just to mention. And I thought, why don't I just talk a little bit about what is the stock market? And we'll start at that point. So if you go outside this morning and you walk around town, if you're like you see in Thailand, a lot of places are closed, but you will see stores that are open. And those stores and other things that are open, those are businesses. And, you know, the other day, I was a couple of years ago, I was walking around Bangkok and I went into my barber, which my barber doesn't have a lot of work to do, but I went in to see my barber and I asked my barber, hey, can I buy a steak in your barber shop? And he said, yeah. So I bought a steak in his barber shop. I just bought 1% of his barber shop. And then I was walking down to the supermarket and I asked them, hey, can I buy a steak in this supermarket? And then I walked down the street to the next place and I said, hey, can I buy a share in this business? And then before you know it, I had 10 businesses that I owned a little portion of. That's the concept of what we talk about when we talk about the stock market. It's like you own a little tiny portion of many stocks, many businesses, but those businesses are around the world, they're global, they're bigger. So of course, I didn't actually invest in all of those businesses around my neighborhood. But imagine if we could, then we would get the benefit of the hard work of those people because they're running their companies, and from their companies comes profit. And we would get a tiny little share. If I bought 1% of the company and the company made 100 in profit, I get 1. And that's the concept that we're talking about. And that is the profit of a business is paid out as dividend. I get a little bit of that dividend. So this is a little bit about what the stock market is. And when a company gets big, they go to the stock market to go out to the public to say, hey, we're taking money from outside. And if you think about it, think about Starbucks as an example, of one from America, where I originally am from. There's no way that Starbucks could have expanded across the world if they had to have financed it all on their own with the money that they had from the banks. So going to the stock market allowed them to raise that money, and people got to participate in it. So this is the first thing that I would say is, a little bit about the stock market, but also, you know what? I'm here for you guys too. So you make sure that you ask questions as we go through this, because Elizabeth and I have reviewed a lot of different questions and ideas, but any questions that you have, feel free to drop them in the chat. All right, Elizabeth, I'm going to hand it back to you.
Great. Thank you, Andrew. So you've mentioned like what the stock market is. It's a place where we grow our wealth, right? So it's basically loads of companies like are listed on the stock market, and we are able to help them raise finances by buying a percentage of that stock, right? So there are a lot of financial terms that go into like that we hear. I heard you talking about mutual funds. Like, can you tell us a bit of these terms and explain what they mean so that as we go forward, people are not too confused?
Okay.
And someone mentioned IPO.
Yeah, IPO, and how can a total novice learn in the simplest way? Great point. And that was what my niece was, So let's talk about when a company does an IPO, it basically is coming into the stock market. And when it's coming into its stock market, people can buy into that company. Then that company will get money from investors. And then those people who invested money, once the stock goes into the stock market, then people can buy and sell the stock. Now, the company's already received the money. There's no more money going into the company. They're making profit as best they can from that money. But the benefit for the average investor is that they could always sell or buy that stock if they wanted to get in or out of it. So the stock market ultimately only really just provides liquidity. Warren Buffett, as an example, will talk about how he only goes to the stock market for liquidity when he wants to buy or sell something. He doesn't go to the stock market to try to identify what something is worth, right? And so that's the concept. And so the basic thing is that the benefit of the stock market compared to if you walk around your town and you buy shares in businesses or you buy share in your friend's business, the biggest difference is liquidity. Liquidity basically means that if your friend was setting up a restaurant and you put in 10,000 pounds into that restaurant, and then later you wanted that money back, you're not going to be able to get it back because your friend needs it to make his business or her business successful. So it's very hard to get money out of a small business. But when you have a stock market and that company is listed in the stock market, it means you could exit it at any time. You could sell it and get cash. You could later buy it back. You could do anything. So liquidity is number one. That's the benefit of the stock market. The second benefit is disclosure. When a company goes into the stock market, it is required to announce the amount of profit and loss that it's making. And by doing that, it brings that information out to the world, and the world then will adjust the price of that company's stock based upon that. So this is the concept. Now, I just want to mention somebody, I see Camelia asked about trading in penny stocks. Now, in the stock market, there's stocks that have a very high price, and then there's stocks that have a very low price. Stocks that have a very low price tend to be stocks that have bottomed out, they bombed out, they may be in trouble. These stocks are what you would call penny stocks. And these stocks, some people try to trade them because they think, oh, I could buy it at 1 and it could go to 2 and then I'd be rich. But penny stocks are extremely risky. And ultimately, when I said create, grow, protect is the part we want to talk about briefly. And that is the idea that There's no way my mother would have been able to get to 80 years old and having $1 million in her portfolio if she was, let's say, trading in penny stocks. It's too risky. She would have lost her money at some point along the way. So therefore, what's critical about the stock market is we see it as a place where we slowly grow our wealth. So that gives a little bit of answers, but I'm going to hand it back to you, Elizabeth.
You
got to unmute. Yep.
Yeah. So could you tell us a bit about some terms like you mentioned before, like mutual funds?
Mutual fund.
What are mutual funds? Okay.
So now let's talk about, you'll have to cue me, Elizabeth. I'm getting old, so I can forget these things. So let's just talk about the riskiest thing that you could do in the stock market. The riskiest thing that you could do in the stock market is buy one stock. Why is that? Because the problem is that if that stock goes bankrupt, then you've lost all your money. Now, if you bought 10 stocks, then if that stock went bankrupt, you only lost 10% of your money. If you bought 100 stocks and you put equally into them, you only lost 1% of your money. If you bought 1,000 stocks, you only lost, 0.001% of your money. So the point is that as you add more stocks to the portfolio, it matters much less what's happening with any individual stock. Now, so that's the first thing that I want you to think about. And how do you own many stocks? So for instance, Camelia asked about the penny stocks. Well, I suspect that if anybody starts trading the market, they think I'm going to buy 1 or 2 stocks and that's it. I'm just going to pick the best ones. This is the most disastrous. It's like getting into a car and not putting on a seatbelt.
Yeah. And sorry, could you just define exactly what does a stock mean? And then please continue.
Yep. Yes. So a stock is also like a share, and it's a portion, it's the evidence that you own a share in that company. And the reason why we call it stock is that it was originally stock certificates, and you would actually have to get a written certificate signed and stamped by the company that you own stock. And if you wanted to sell your stock, you had to go down to the stock exchange and take that and then sell it in the stock exchange. So that's why we call it a share and a share certificate. But nowadays we oftentimes call it a stock, and it's all electronics now. You just say, I want to buy 1 of those or 2 of those, and then it automatically happens. And you buy stocks through a broker. A mutual fund company is setting up a mutual fund, and what do? They solve a problem that you will have. The problem is that you now know you shouldn't own 1 stock. So the minimum number of stocks that you should own at any time is 10 stocks. And this comes from a lot of academic research, my own academic research and others. You should own a minimum of 10 stocks because you never know which one could go bust. But then you have a problem for my nieces. And my nieces basically said, I don't know how to pick even 1 stock. How would I know how to pick 10? A mutual fund solves that problem because a mutual fund is run by a person like myself, and we own many stocks, 100 stocks, 1,000 stocks. And then when you put your money in a mutual fund, let's say you put $100 in a mutual fund, that $100 would have only bought 1 stock if you had bought it alone. But now with $100, you're putting $100 into the mutual fund. That $100 is being spread across, let's say, 1,000 stocks that are owned by the mutual fund. And so the mutual fund solves a major problem that you can get diversification across many stocks without any trouble. So how about that? Now let's just see some of the things that have come in. Okay, I did that with Hertz. What a shame, I lost money. Yeah, I mean, the problem is now, what I want to mention about the penny stocks and investing in stocks, there's one major serious problem that you need to know, and you need to know it very clearly. Let's look at a parallel. How does the news make money? The news stations around the world make money through advertising. And what is it that sells? If the news came on, if I was a newscaster for the day, Elizabeth, and I came on, I'd say, well, welcome to Thursday, 6 p.m. news. Today, it was a beautiful day. I'm going to tell you a story about a happy couple that are living a happy life. And I'm going to tell you the story about a kid that just graduated from school with straight A's. Hey, and we don't talk about murders and violence and all of this stuff, right? Nobody's going to pay attention. People pay attention to these things, and the news is feeding into our brains. It's the same thing with the stock market. People talk only about their winners. And so they're talking about their winners all the time. Oh, I made money in Hertz. I made money in penny stocks. I made money in this. But how many people talk about their losers? Most don't. And therefore, it's not strange that a newcomer to the stock market thinks, God, I'm not that smart. I mean, everybody's making money here. And my first stock I bought, it went down. So it's important to remember that people always talk about their winners, and they don't tell you about their losers. But in the end, it's a combination of all the stocks that you have bought or held over a long period of time that really matters to build up your wealth over time. Okay, so how do we go about setting up a mutual fund? Okay, let's talk about that for just a moment. Let's say that you listened to this discussion and you said, okay, Monday morning, I'm gonna go find I don't know what some mutual funds are in London, but let's say Foreign and Colonial, or in America, it's Fidelity, there's Vanguard, there's many different types. But let's say you call them up and you go, I want to open up an account. No problem. Yeah, okay, Vanguard and Fidelity. Let's just talk about Vanguard. I mean, there's no sense in wasting time, because Vanguard basically is the only mutual fund that is not for profit. Actually, they make a small amount of profit, but any excess profit, it goes back to the shareholders, back to the fund holders. No other fund management company is structured that way. That was the way that they started from the beginning. So they can make their fees lower than pretty much every other fund. Okay, so you go down to Vanguard, or you get on the phone, or you go on the computer and you open up a fund account. And then basically, it's pretty simple. They're going to have a minimum amount. It could be 1,000 pounds. It could be 3,000 pounds. You're going to put that money into the account that you have. And then after the money's in there, you're going to tell them, okay, with that 1,000 pounds, I want you to buy this fund of yours, Fund A. Now, Vanguard's going to have maybe 100 funds, all sliced and diced in many different ways. They could be all stocks in the market. It could be just stocks that are technology stocks. It could be just stocks that are in London or in the UK, or it could be stocks that are in America. There's many different ways to slice it. But basically, you could open up a mutual fund account on Monday very easily. Okay, keep the questions coming. And let's just say, do you have to pay the mutual fund to get their service, or what's the average fee for this? Okay, good question. The way that every mutual fund charges you is they charge you a management fee. And that management fee can range from 0.1% of the money that you put in, or all the way up to 2% of the money that you put in. And that's a pretty wide spectrum. So basically, you're going to be paying. Now, in the case of Vanguard, it's going to be something like 0.1 to 0.4 maximum. Maximum would be 0.4. I'd have to look at it. And I think we can do a follow-up work here where I look at what offerings are available in the UK, and then we can review that. Elizabeth, I think that's a good little follow-up. We can make a little cheat sheet of what we can find in Vanguard in the UK, because I think it's different from what's in the US.
Sure.
So let's take a note of that, and you and I will get some homework there.
Yeah.
So then that way you can set up a mutual fund pretty simply. So let's continue. Any questions? Keep the questions coming.
So, Andrew, I know you've been talking about mutual funds, and that's great. But there are other alternatives. There's index funds, ETFs, exchange-traded funds. Could you just share with us so we all know what are the differences between these and what do they mean? Okay, good.
Yeah. Camelia says, I love a cheat sheet. I loved it too. I have to admit, I used it when I was in high school occasionally in exams. So let's talk about the general umbrella term is called mutual fund. But there are two types of mutual funds: the active funds and the passive funds. Now, the active funds are where you pay a fund manager And he or she is going to basically say, all right, for this year, we're going to reduce our exposure to the US and we're going to increase our investment exposure to, let's just say, Asia. They are actively trying to pick the region or the stocks that they believe are going to outperform the average. They're going to beat the average. This is an active fund. The majority of funds in the world are active funds. Now, Vanguard was the beginning of this concept of passive fund. And I'd like to teach about it. I don't actually have it in my course, but I used to have something in my live courses. I called him Passive Paul. And I had a cartoon drawing of Passive Paul. And Passive Paul just basically walked into the office, turned on the computer, and he did a little bit of rebalancing, but he bought every stock in the market. While the active fund manager was sweating it out, trying to figure out what's going to go up, what's going to go down. Passive Paul went in every day for about an hour, turned on his computer, and he rebalanced the stocks so that they matched the index, the stock market index. And that's all he did. He never, ever tried to beat the market. And that's why I call him Passive Paul. He's just kind of passive, and he's just matching the market. And you may ask, but Andrew, why wouldn't I want to beat the market? Right? Is anybody asking that?
Yeah, like why would we want to beat the market? Because if the market is giving a return of, I don't know, 7%, for example, why wouldn't you want to have more if you can?
Yeah. Okay. So the problem is, it's a little bit like the stock market. Oh, sorry, it's a little bit like the casino. Let's go back to the casino. Let's just say it's a weekend. There's 1,000 people that go into the casino. What % of those come out winners? Can I see it in the box? What % of those people that go into the casino on Friday night come out on Sunday big winners? Okay, let's see some numbers here. All right, so I see 5, 2, 1%, 3%, 0.5, 5%. This is great, guys. I really appreciate how active you are in, putting in what you're thinking, because it helps me. Very little, no idea. Okay, so let me answer this question. The answer to the question is, you're right. It's a tiny number of people that actually come out winning big. Yeah, there'll be some people that win a little bit, and most people will be losing. It's the exact same thing in the stock market. You wrote down the numbers of 1, 3, 5%. All the academic research shows, almost all, it's unanimous though, that basically over a 10 or 20-year period, you're going to find that only about 5% of active fund managers beat the stock market. My God, how do they still have jobs? That's probably a good question.
Yeah, definitely. So you're saying active fund managers are those that you pay to for them to pick funds for you to invest.
Pick stocks, because the fund is investing in stocks.
Yes.
So they're going to be picking stocks, and they're going to be trying to beat the market.
Mm-hmm.
And now let's just see what some people have said. Then why are most of the funds in the market active if the failure rate is so high? And our RGB says, why bother then? Also, is it a bad strategy to just want to be a day trader or short-term trader? Can one build wealth? Or is that too risky? It's too risky to be a day trader. I'll just tell you that right now. Penny stocks and day trading, these are like pornography. They're all over, just attracting people, and they are really, really high risk things. So trading is not a great idea, particularly because the world of trading is dominated by very experienced people who have massive amounts of money and resources to trade faster than you. So trading, meaning buying and selling on a short-term basis, is a problem. Now, We have Money Box in the UK where you invest using spare change into various companies. What do you think of this? Elizabeth, can you write that down? I need to understand Money Box.
Yes.
And let's do that, and we'll follow up on Money Box, Sylvia, and I'll have some idea
Yeah.
for you.
Yeah, it's
Okay,
so the phone app.
Yep.
Mm-hmm.
I just need to go through it just to make sure I understand what it's doing before I say. So now let's go back to why the average fund manager underperforms. Okay, but before we do that, I'm going to ask you guys another question. Now, this time, everybody must participate. And I don't want you to put in anything that somebody else wrote. Don't look at what other people write. Just think about it for a second. Don't write anything yet. Get your number in your mind. Get your number in your mind. I'm going to ask you a question. What do you think over the last 30 years, what do you think is the average return, average annual return in the stock market that the average person would have earned? What do you think that is? You got your number in your head? Just make a guess and then start typing it. We're talking about percentage. What percent average annual return did people make in the stock market? I'm not going to shout them out because I want you just to pick whatever comes into your mind. Oh man. Okay, it's good. Everybody's participating, which is awesome. All right.
Great.
Okay. Demola. That's nice. I like that number. Okay. So we've got, now I think one of the things that we need to do is we need to download, at the end of this event, we got to download that chat because I want to do some calculation based upon that number myself to kind of, we can do a good follow-up with that. That's good information. All right. So, okay. So now what I would say is that, so what numbers have we seen? We've seen as high as 80. We've seen as low as 2.5. The answer to this question is about 8%. Now it depends. Are you talking, am I talking about, I didn't actually ask you the question very well. I said the average return in the stock market. I didn't clarify. Are we talking about the US stock market, the UK stock market, the Thai stock market where I am, the global stock markets? But I purposely kept that vague. But generally, if we look at the US where we have the longest amount of data, it's going to be somewhere between 8 and 12%, depending on kind of when you pick the numbers. It's a little bit like children. They pick the numbers that reflect good on them. So most people, when they study that. So I would say that you should expect that you would earn about 8% in the stock market for the rest of your life on average. There could be a year where it's down 30% and a year that it's up 50%, but on average, about 8%. So this is the first thing that we want to understand, is that it's not nearly as high as what most people think. The second thing is that in order to beat 8%, let's think about the active fund manager. What did I tell you that the fee was? It's about as much as 2%. That means that the active fund manager has to make 12% in order to beat the market. In order just to give you, let's say, if the average return was 10% over a 30-year period, they'd have to make 12% just to provide you with the same return as the market. So if they were actually going to be better than average for you, they'd have to earn 13 or 14%. Now, I just did a calculation the other day, and I want you to think about this calculation, and I want you also to guess this. This is a good one. Now, what I'm telling you is that the average return in the US stock market was about, let's say, about 10% roughly over the last 30 or so years. The average return in the US stock market was about 10% in the last 30 years. Let me ask you, the best investor in the world, Warren Buffett, I calculated his average annual return over that period of time. What do you think it was if the return in the stock market was 10%? What do you think Warren Buffett's return was? Type it into the chat. The best in the world, we're talking, right? So it can't be 8% because that would be below, right? We said it's about 10% on average, so it's got to be higher. 60, 30, 25, 30, 14 to 60, 100, 55. Yep. Okay, 20, 20. We've got some good numbers, 40. The answer to this question is 17%. That's it. The best guy in the world, in the stock market, over 30 years, earned 17%. That means that, you know, a really good fund manager would probably earn 13%, maybe. So what you can see is that it's very hard to outperform the market and particularly outpace your fees. So there's two reasons why the active fund manager underperforms. Number one, we've established now that a lot of it has to do with the fees. And so they have to perform better than the amount that their fees are. The second thing is that it's just hard. The stock market is 10 times more complex than going into a casino. In a casino, and you play blackjack, you can see the card deck. You know how many cards are in that deck. They may have 10 decks, but it's a finite number of cards. Somebody that could calculate that in their head could calculate the probabilities of the next card coming up. But you cannot do that. It is an infinite number of possibilities in the stock market. So two reasons why active fund managers don't outperform. Number one, the fees that they charge are high. And number two, the stock market is so complex that it is extremely difficult to outperform.
So we've spoken about those two active funds, which are, like you said, everything's a mutual funds, but the ones with actual people, you know, controlling them are active funds, and passive funds are, you know, funds where there's no fund manager, and these are index funds or ETFs, right?
Yep.
So
let's talk about that for then, because we're going to talk about ETF. And we're going to talk about passive funds. No, it's not hard work. Trust me. It's just that we have to understand the truth. And I think there's a great saying, and that is, the truth shall set you free. So I know it's a little bit of a negative, but the truth will set you free. So why? Okay, so let's asking again. Why are most of the funds in the market active if the failure rate is so high? The answer to that is that in the past, there was no passive fund. There was only active funds. That's the first thing. The second thing is, let me ask you this. How do I pronounce your name? Halima?
Yeah.
Okay. Halima, let me ask you a question. Are you ready? Halima. Okay. My question to you is, you guys, all of you told me that on a weekend in a casino, only maybe 1 to 5% of people would walk out winners, big winners. The rest would walk out even or losers. So let me ask you this question. Are casinos empty? Why would anybody go to a casino? They're not empty. It's because human nature thinks, I gotta beat this. I'm gonna do this. I'm gonna try. I'm gonna have fun. It's gonna be exciting. So the whole world of finance is geared towards the marketing of these funds, the superstar fund managers talking on CNBC about their fund, but they're charging a very high rate. And now you know, now you may say, Andrew, who are you to tell me this? How do I know I can believe you? Well, basically, I would say you're probably not going to talk to many people that have got to where I've gotten. With a PhD in finance, doing a lot of research, having worked in the financial field as a broker, as a fund manager, I understand very well what's going on.
So you're one of those active fund managers?
Well, basically, for 20 years, my clients were the active fund managers. So I understood them very well. And we didn't have passive funds when I started. So one of the people in here is 18 years old. That person gets a chance to buy passive funds.
Yeah.
So let's just now move on. Yeah, it's the faith of one day I'll win big. Let's move on I think we've talked enough about active funds, and it's enough for you to understand that now that we're going to just talk briefly about passive funds. Passive funds don't try to beat the market. They try to match the market, and they are able to do it very closely. The only difference is their tiny little fee. So if the market went up by 10%, that passive fund, it may have gone up by 9.9%. You don't have all this, the stress and headache of, oh, did I pick the right fund manager or anything like that? This is just going to match the market. So that's the thing. Now, let's talk about ETF, exchange-traded funds. Generally, you guys probably don't need to worry too much about ETFs. Generally, if you're starting off small, let's say, and you're investing a small amount every month, it's probably going to be better for you to go to a mutual fund. And I say that because you have to do some calculation about the cost and which one's better. But the cool thing about Vanguard is you can call them on their hotline and ask them, which do you think is better for me, a fund or an ETF? But now let's talk about what is an ETF. So we have a fund and it owns stocks. Let's say it owns 1,000 stocks. The way you buy that fund is you put money at the fund management company, and the fund management company puts that money into that group of stocks. Many years ago, 30 years ago, 25 years ago, somebody came up with the idea of an ETF. And all that was it's another instrument to be able to invest in that fund. But that instrument trades in the stock market. So instead of giving your money to the fund management company, you call up your broker and you say, I'm going to buy that fund through its ETF. And the money goes into the ETF and then into the fund. So the underlying fund is exactly the same. The ETF is just another way of getting access to the fund. That's it. And for most people, you probably don't need an ETF. Now, if you tell me, Andrew, I've got $20 million and I need to allocate that, and an ETF is a good instrument for that, to get in and out of that passive fund pretty easily. But for most people, it's probably just to focus on a fund. So basically, based upon now, I'll even tell you, and Elizabeth's taken my course, she knows that I give a couple different funds that I think are interesting, and I'll just tell you what they are. The number one fund that I would say you should go to Vanguard and look at is called the VT fund, VT. And the VT fund, I don't make any money from telling you this, but it's exactly what I told my nieces. And the VT fund owns every stock in the world. They own about 8,000 stocks across the whole world. And if you went and bought that on Monday and you put £1,000 into that, and every month you put £1,000, you would be, off to a good start.
Yeah.
All right. So now let's just see, what are your thoughts on investing in gold and silver mining companies? Okay. So let's just talk about investing into companies first. Once you own the VT fund, you own every stock in the world. So, when you go out to a party on Saturday night with your significant other, and you go to a party, and you go and you hear, let's just say that you bought the VT fund on Monday, and now you have $1,000 in the VT fund. And now that means that you own a tiny sliver of 8,000 stocks. And then you hear somebody fancy like myself or some finance guy, man or woman, and they're always talking big about stocks, and you're thinking, I don't know anything about this. They're going to say, hey, I just bought some gold mining company stocks, and they went up, and they're doing really well. Remember, first, Andrew told you they only talk about their winners, number one. But number two, I've got a great party trick for you for the rest of your life. You can say, I do too. I own gold mining stocks too, because I own every stock in the market, 8,000 stocks across the world. So if that man or woman owns a stock in the stock market that's a gold stock, you own the same thing. And then another one says, well, I own Apple. And you say, yeah, I own Apple too. And so I say, well, I own, IBM or whatever that is. You say, yep, I own that too. So with a mutual fund, particularly a passive mutual fund that owns every stock in the market, you now own every stock in the market. Now, so there is no point in buying individual stocks unless you are building a career as like a fund manager or a career spending your time picking stocks, it is very hard to pick. And remember, I told you, minimum number is 10 stocks. And it's hard to find those 10 stocks. So it's a full-time job to pick stocks. So I would just buy the VT fund. Now let's just talk about the next thing, which is gold. Now, generally, gold has not really done that well over many, many years. So it's not like it's the reason why we like to invest in stocks is because stocks mean we're investing in companies, and companies are run by CEOs, and CEOs are trying to build their companies and their products and their service so that they can cope in this difficult time and they can still make profit and pay their employees. They're constantly evolving and trying to improve themselves. And so when you invest in companies, it's different from investing in something like gold. There's no improvement. Gold is just you could say it's a safe haven or a place that you could put your money, but it's not where you would necessarily grow your money.
Okay.
Saying a lot of stuff. I feel like it's a lot. And, as Elizabeth has known, I've put this all into a 4-hour course, basically, to try to figure out a way. You do have to spend a little bit of time to learn this stuff. It's just like if you go, anything, if you want to have a healthy diet, you have to learn about nutrition a bit, right? So there is something to learn. All right, Sylvia, I'm glad to hear that. You warm my heart.
And if you guys stay to the end, Andrew's got a fantastic gift for everyone.
Yep.
So we're learning a lot of terms, and he's going to help us. So in terms of how to actually invest, so like in the UK, we have like Robo Advisors. And this is like, basically it's you buy a portfolio, you can't modify it. They have the fixed what stocks are going to be in that portfolio. And this is like Moneybox is an example of that. And another one is Nutmeg. So you buy that, it's a Robo Advisor, like it's like,
Yep.
I guess,
Yep.
an online one. So you can invest that way. And then we also have like fund supermarkets, which is what, you've been talking about. And then this is like for the DIY investor, like you're
Yep.
going to, open this account yourself. And like someone mentioned earlier, we have Fidelity, we have Vanguard. We also have like AJ Bell. And you decide how you want to allocate your assets, right? And how you want to build that. And in those accounts, you can pick to have 100% of stocks or mix it up in your asset allocation. So I wondered if you could just, for a brief moment, explain like what is asset allocation.
Okay.
and
Yep.
and a bit more about that. Share your thoughts.
Okay, so let's talk about those different ways of investing. The simplest way to invest is to call Vanguard, buy the VT fund, put in a little bit every month, and forget it. The second way of investing is the idea of a Robo Advisor. The Robo Advisor is a good way of doing what I'm teaching, and it can automate that process. You just have to be careful. Some Robo Advisors are buying active funds, not passive funds. Some Robo Advisors are doing more risky things. So we would have to look at those Robo Advisors a little bit to kind of give you some guidance on it. But a Robo Advisor is not bad. It's like taking this passive concept out to the masses at a low cost.
Yeah.
The fund supermarket is just to say, I'll buy my own funds, I'll make my own decision. And a fund supermarket allows me to buy one fund from Fidelity and one fund from Vanguard. But it comes down to how much time you want to spend. And when I've told you now that we create, grow, and protect our wealth, and we create our wealth through what Elizabeth said, like when she tried to improve her knowledge, bring more value to her company, these are the ways, or starting your own business, these are the ways we create wealth. And so I want to talk to you a story. I just want to tell you a short story. And this story is about a friend of mine. And he has a son who loves basketball. And his son is about 18. And his son said, Dad, I've decided that I'm going to put the whole summer into getting better at basketball so I can become a college basketball star. And the father said, great. And then he said, son, I want you to study the basketball greats, and I want you to come back to me next week and tell me what are the 3 most important attributes of a great basketball player. So the next week, the son comes back and he says, Dad, I've figured it out. It's 3 things. Number 1, they've got to be tall. Number 2, they've got to be fast. And number 3, they've got to be strong. The father says, I think you're right. This is very true. Those 3 things are the determining factors of being successful. So now, son, he asks him, which one of those 1 things are you going to focus on this summer? Because you can't get better at all of them. You've got to focus on 1. And the son thought to himself, I'm going to focus on 1. So let me ask you guys, what would be the 1 thing that you would want your son to focus on of those 3 things? Can you just type it in? I said tall, strong, and fast. Those are the 3 things. Which would you tell your son to focus on? Strong, all right. Fast, speed, yep, okay. Yeah, I mean, I don't know about you guys, but I've been watching The Last Dance of Michael Jordan. I mean, I practically cry at every episode. Strong, fast, strong, okay, yep. You do see some basketball players that they take time off and then they basically spend time getting stronger. Yep, strong, okay. But what his son said to him was, Dad, this summer, the thing I'm going to work on is I am going to get taller. And
Okay.
the point is that if you focus on the wrong thing, you're going to miss the opportunity. And the wrong thing is all of the shiny objects that are happening in the world of finance. The more important thing is to think about how I get started, how I contribute a little bit every month, how I come up with a safe way of doing that. Yeah. So now you had a question, but I diverged. Sorry about that.
Yeah, it's okay. So just to recap what you said, those are a really great points. So we are focusing on creating, growing, and protecting our wealth. And we create our wealth, by increasing our value, whether it's via our jobs or via our businesses, and just increasing value for other people and increasing our income. And then we grow our wealth. One way of growing our wealth is in the stock market. So we can do that time after time. So this is not where we are creating our wealth, right? So this is where we are growing it. So just for people to clarify, when investing in the stock market, you're already creating something that you want to grow and you want to expand, and you want to make that money work for you, right?
Yep.
Okay, so we discussed about fund supermarkets and by a DIY investor, doing it yourself with a passive fund.
Yep.
And I asked about asset allocation, like how do you allocate what is asset allocation? Yep. Why is it important? And how do you do it?
Okay. And also we got a question from Tola about ISA stocks and shares tax-free advantage. Now,
and because a question about COVID-19 pandemic affecting.
Yeah. Okay. So let's just talk about every country has some sort of tax advantage that if you invest in a particular type of investment, you could get a tax advantage. Generally, the first thing you want to do is put your maximum amount in. It may be 5,000 pounds. It may be 10,000 pounds. Generally, the rule is you're going to put your maximum amount in that because that's going to save you taxes.
Yeah.
And if you save taxes today, that's very valuable for the future. Then over and above that, then you start to keep investing. Now, let me just talk briefly about the next one, which is how has COVID pandemic affected the stock market, negative or positive? Now, this question is a type of question that would have turned off my niece. If she had to figure out when to buy, when to sell, it would be more complicated than she could handle. And so basically what I told her is just every month, put in a little bit of money, same amount in the Vanguard fund. It's something called dollar cost averaging. And don't worry so much about when the stock market's high and when the stock market's low, because these items don't matter 20, 30 years ago when you're 80 years old sitting down with your son and you've got $1 million. It didn't matter that 40 years ago you put in $1,000 in the stock market was a little bit high, because you also put some in when it was a little bit low. So that's a very important point that's critical, is that the mistake that most people make is like focusing on getting taller, is that they get caught up in, is the stock market expensive or whatever? The VT fund allows you to buy every stock in the world. Just start, contribute, let it grow, because it takes 20 or 30 years for it to grow. All right.
And in the UK, that's called pound cost averaging. And and yes, Tola, you know, we have a tax-free advantage of £20,000. You can invest, save in your ISA and invest that into stocks and shares up onto £20,000, and it's completely tax-free. And the benefit of pound cost averaging, which is drip feeding into the market, that is like regularly investing. So if you want to invest like a bulk sum, you just break it up and put in a little bit every month and keep going, is because you can't time the market. You don't know when it's going to be high and you don't know when it's going to be low. In terms of COVID-19, when the COVID started, in terms of my own stocks and shares ISA, when the COVID pandemic started, it dropped. Yeah, it actually did drop. But now, right now, as at yesterday, it has grown way past that. So I did lose, maybe I think it was 7%. And now it's grown way past that, you know, and it's closer to 5.6. And we're still in the pandemic. We're still in the pandemic. So, and I'm still like regularly putting in a little bit every month into those accounts. And
so let me mention about that. There's two things. The first is that the ISA, or the tax advantage, can sometimes be done at Vanguard or Fidelity or one of those, and you can actually invest sometimes in those low cost VT fund type of thing, right? The second thing I want to just say that I told my niece, to make her life very simple: never sell. Now this is risky, right? You must be thinking, my God, Andrew, how is it? I mean, surely at some point you must sell. Well, if you're talking about an individual company and you think, oh, that individual company is going to go bankrupt, yes, you would sell. But when you own every company in the market through a passive fund, you're just riding the market up. And the idea that you could sell to pick the time that the market is, you know, right to buy or sell, that's very difficult. Okay, so therefore, whenever you think about my style of investing and what I'm talking about, it's really, the idea is you don't want to put money in there and then 6 months later say, oh, I got to take that money out. So it's better to start small and slow, right? Yeah, just to clarify, the VT fund is passive and for the long term. And also to clarify, I'm not recommending that fund, but that fund is kind of the pinnacle of funds that are passive. So at least start your research there. Yeah. Okay. And now let's just talk about asset allocation for just a moment, because you've asked me that like 3 times now. So asset allocation, really, there's 2 main asset classes. The first one is stocks and the second one is bonds. Bonds are generally going to be bonds of the government or bonds of companies. When we talk about a bond is just basically lending money to a company. A stock is investing money in a company. And because when you lend the money to the company, it's lower risk, because you're going to get paid if that company goes bankrupt. You're going to sell the stores and you're going to get back some money. So bonds tend to earn a lower interest rate. In fact, nowadays, bonds earn a very low interest rate. So asset allocation is the idea of owning mainly stocks. Stocks are going to always be your long-term main thing that you're going to buy, and mixing in a little bit of bonds. And you could mix in a little bit of gold, depending on how complex that you want to be. So that's the concept. And in my the case of my nieces, already I'm getting too complicated for her. And that's why I say, I gave her kind of a formula, which I teach in the class, and say, just follow that, you know. But a robo advisor will be investing in some stock and some bond fund. And they'll do it according to their own calculation or their own belief, right? As opposed to if you do it on your own, following my way, which, you know, either way, you can do that.
Yeah.
If you want investment that can sustain your monthly bills, a source of income, what can you recommend? Well, let's just think about it in that case. You know, the best investment that you can make, or the best, let's say the best way to create wealth, is to create a company. I have one of my companies that I own is a coffee factory. We roast coffee. We have 100 employees here in Thailand. I don't run the company. My best friend does. In fact, after this call, I'm going to go have dinner with him. But I own 40% of the company and he owns 40% of the company. That means that if the company makes profit of 100, I get 40. And every day, everybody in the company is working harder to try to make more, you know, get more customers and make more money. So a business creates wealth for you in a passive way. And it's the best way to to create your wealth. The second best way is to cut your costs. Let's just say you're making 100,000 pounds in your job, everything's going fine, but you're spending 110. You're not creating wealth, you're actually destroying wealth. But let's say that you got smart, you listen to what Elizabeth said, she's helped you to really put it together, and you realize, I'm moving to a lower cost flat, I'm going to reduce my cost and get it down to 60,000 pounds. So now I'm making 100,000 pounds, I am only spending 60,000, I have created 40,000 pounds of wealth. And that is what we grow in the stock market. But you can't create that 40,000 pounds of wealth in the stock market as easily as you can by cutting your costs. So first, if you have a successful business, but it's very high risk, you could lose it all. Second, cut your costs and have your costs be deeply below your income. And third, grow your income. You can only cut your costs so much, and then you have to grow your income. And how do you do that at work? You do that by improving your skills. Maybe you go to another company, you try to bring more value to the company, and then you grow that. And that's the idea when I say create, grow, protect. That's how you create stock markets where you grow. And protecting has to do with your asset allocation and being safe by investing in a passive fund and, you know, being very careful.
Great. Thank you so much.
Yeah.
And in terms of like, for us here in the UK, I'll just mention a few things that, you know, you can do in terms of how you can start, you know, growing your money in the stock market, right? So first you can invest it with your pension. And if you don't have a workplace pension, you can do a self-invested pension plan. So that's like an SIPP, and you can research that. You can set that up and still do exactly what we're talking here. And the only difference is you can't take the money out before you are a certain age. For some companies it's 55, for some people it's 59. So, and then other things that you can do, like Tola mentioned, is you can invest it via an ISA, a stocks and shares ISA. So you get the tax advantage. You know, you get up unto 20,000 pounds tax free. And another thing that you could do, you know, especially for your kids, you could have a junior ISA for your kids, right? And then you could start investing, putting a little bit and you know, growing that for if you want to help them with regards to university, or you help them with regards to something else in the future. And apart from that, you can just, you know, have a general investment account, and that will be taxed eventually, but you know, you're still going to be making, you know, you're still going to be growing your money. And also with your pension, it's usually taxed at the end, so when you are about to get retired. And just, you know, I just wanted to talk about numbers. Let's say people are having ideas. I'm sure everyone has ideas of like how much they would like to make via the stock market, maybe in the next 10 years, 20 years or whatever. should we discuss like how much we can make? I have a calculator up here and I can calculate compound interest. So maybe you can just like in a sentence explain to us what is compound interest, and then people can put down how much you would like to have, from your investments in the stock market in X amount of years, and we can do some math so that people go away with. And someone has a question, but we'll come back to that.
Yep. Okay. Okay. So imagine that you put 100 pounds in the bank, and for fun, let's just imagine that the bank paid you a 10% interest rate. That means at the end of the year, you're going to have the 100 that's still at the bank, and you're going to have a 10. Now, let's imagine that you take that 10 out and you go have a little party. You take your wife, your girlfriend, your husband, your boyfriend, your girlfriend, whatever, out, and you have a little party, you buy something, and then the next year, that 100 earns another 10. And then you take that money out. And then the next year, that 100 earns another 10, and you take that money out. The thing that's going to happen in this case is that the money's never going to grow, right? But you are going to be able to use it every month. And that's the case of my mom, right? She can use the money every month because she doesn't need it to grow that much anymore. But the truth is that let me ask, how many people here have seen or heard about this idea of compound interest? Have you seen the chart where it shows that an investment will grow exponentially in the later years? Has anybody seen that compound interest, or the concept of compounding? All right, so Dola says yes, yes, Kenny. All right, no, yes, no. Yes, okay. Yep, okay. So now let's talk about that. So the concept of compound interest is that instead of taking that 10, it never adds up. Instead of taking that 10 out of the bank, you leave it in. And that means that the money that you leave in the bank now is 100 plus the additional 10. So at the end of the next year, you get another 10 for the 100 that you have in, plus you get 1 because you earn 1% of that 10, or it's actually 0.1. So you're going to earn interest on the interest of the 10. And that is what compound interest is, or compounding is. It's the interest on interest. And it turns out that if you just leave your money in there to compound over time, that compounding component that started at 0.1 will grow to be about 80% of the money that you have in your account 30 or 40 years ago, or 30 or 40 years ahead. So it's a huge, powerful tool. And it is, if we look at, getting stronger, taller, and faster, it's stronger or faster is what you want to focus on. And that's having your money compound over time. But there's a dirty little secret about compounding that most people don't understand. And I think I can tell you what this secret is. It goes back to the question of what can I invest in that would pay my monthly bills? Let's say you had enough money that you invested money and you got income from that money, like that 10. If you take that money out and you pay your bills with it, you're never going to get the compounding effect of that exponential growth. Compounding, the calculation for compounding in the world of finance, always assumes that all money you earn from the investment are reinvested in the investment. And most people don't realize that, and they think they can take some money out of it. But in fact, you must leave the money in. And this is the reason why I told my nieces, never sell. In fact, if you gave, 10,000 pounds to each of your kids, and one of your kids went around the world and then they got lost, and 50 years later they came back and they never touched that money, I guarantee you that money's going to be huge compared to the other ones that are probably going to take some out and buy and sell and do all that. So that's where the real value comes in, letting your money grow and letting it be reinvested. And all of these funds, most of these funds and the Robo Advisors have systems for automatic reinvestment, and that's critical. You must do automatic reinvestment.
Thank you. And then I saw another question by Lucy. Any thoughts on Crowdcube? What investment model is this based on? So Crowdcube, I believe, is a crowdfunding website that for businesses. So it's crowdfunding for businesses.
Yeah. Okay. So crowdfunding for businesses means that instead of buying stocks in the stock market, why not buy stocks in the companies that are in your neighborhood or in your country that are not in the stock market? Crowdcube and this type of crowdsourcing allows you to do that. But if you start investing in those companies, the risks are very high. I'm sure many of you have either experienced it yourself or have other people that have lost money investing in small business and their friend's business and all that. Well, this is what ultimately you're doing through a crowdfunding type of thing when you're investing in companies. The only difference is instead of your friend saying, hey, invest in my new restaurant, and you put 100,000 pounds into it, instead you take that 100,000 pounds, you put it into Crowdcube, and then it splits it across maybe 100 different companies. So it does diversify your money, but it is a much higher risk thing. So my answer to you on Crowdcube would be, before you build a portfolio in Crowdcube, get your Vanguard or your passive fund through the Robo Advisor or individually, get it up to about 100,000 pounds and then play around with a little bit of money. You know, it's nothing wrong with having a little bit of fun with your money, but not with the money that you want over the long term. Yeah, lost money last year. Yep.
Yeah, sorry about that dollar.
Yes. Yeah.
So that's so great. Let me so basically just to summarize, like asset classes or ways that you can invest. You know, one is leaving your money as cash, which is low risk, and low risk means like you're probably not going to lose it, right? And you leave your money in cash, it's low risk, but it's like low reward as well. So it's only going to grow as fast as your bank interest rates are now. Then you can invest in bonds, which are also low risks, and these are like loans that you make out to your country, and you know they pay you back, right? They pay you back a certain interest at a particular time. So bonds are also low risk. And then there's shares, you know, and stocks like we've been talking about, and that is buying ownership in a company. You get paid dividends or interest and you reinvest that, right? You reinvest that into your company. And then like Lucy mentioned, there is crowdfunding. It's like peer-to-peer lending. So there's peer-to-peer lending where you are lending money to small businesses, which is what Andrew just explained. It's, you know, hard to get your money back quickly, and also it's high risk. So you might lose your money, but you might also win big, right? Or you might lose big as well. So it's high risk. And we also talked about a little bit about diversification, you know, putting some money in, you know, mixing it up in terms of cash and bonds and shares. But you can set that up quite easily on, you know, in your fund account, like depending on which one you use. If you go through Vanguard, or you go through AG Bell, or you go through Fidelity, you know, whichever one you use, you can set up, you know, how you want it to be diversified. If you want it to be lower risk and more secure, like you can buy more bonds or leave a little bit in cash, or you can, you know, buy more shares in your company. And that's what we've been talking about. Another form of investment I think someone mentioned is Forex. So we've talked about cash, we've talked about bonds, we've talked about shares, we've talked about peer-to-peer lending to businesses, which is high risk. And we talked about Forex a little bit as well.
But I would just advise, Forex is a little bit like penny stocks, and it's a little bit like, it's a very high risk thing because you're betting against the biggest banks and the central banks across the world. But it's a sexy thing that's being marketed on the internet. So you'll be seeing all about Forex, but trust me, it is very difficult to make money in Forex.
Yeah.
Let's answer one question here about, apart from cutting costs, what would you advise for someone who wants to save? Well, first of all, let's say the first step of this is that you have to save. So let's say you're saving £1,000 a month, and then you want that to grow over time so you could buy a house in 5 years, as an example. So it is possible that you could invest that through the Vanguard VT fund, as an example. And then at the end of 5 years, hopefully the market's up and you can sell and then take that money out.
Mm-hmm.
Now, you just don't want to mix that money. We call it mental accounting. We want to set up mental accounts or actual different accounts where you've still got your money that's set aside for your retirement or your financial independence, and keep that going all the time. And then have another fund or another group of money or mental account where you're saving for, you know, an education of a child or a house or something like that. Chi says, what about investing in cryptocurrency? Now, Chi, I have a little bit of a joke I want to tell you about cryptocurrency, because people always ask me, they say, Dr. Andrew Stotz, you're an expert in finance. You've worked in finance all of your life. Tell me, what do you think about cryptocurrency? And I always say the same thing. It's beyond my knowledge. And what do I mean from beyond my knowledge? What I mean from beyond my knowledge is that it is so hard to figure out how to make money in cryptocurrency. It is very complex. I've studied it in a lot of different ways, and I can tell you that it's almost like a randomness. So what I would say is, if you're interested in cryptocurrency, there's nothing wrong with taking 5% of your money, maybe 10% at most, and saying, I'm going to buy cryptocurrency. But it's like, it's just such a volatile ride that it's, you know, not something that I spend a lot of time thinking about. Okay. It was supposed to be like a joke that if it's above my skill, then it must be above the skill of the person who's asking, who doesn't really have any background in the world of finance. So I'm not sure if I'm going to get a ha-ha out of that, but that was my attempt at a joke. All right. That's a finance joke.
Yeah.
Yeah. Okay.
He says, ha, ha, ha.
Yeah.
Yeah.
I've
So,
shed some crypto tears.
I think one thing about high risk investments are that you can win big and you can also lose big. Like those are the, you know, with regards to high risk, you can win big and you can lose big. So,
and I want to correct one thing that you said, Elizabeth.
Yes.
You know, one of the things about what I do compared to, let's say, what Elizabeth does, and the reason why I don't advise people individually or give that type of advice, because I don't know about the UK and I don't know about, you know, different countries, you know, and also the whole idea of how to create your wealth. I think Elizabeth really has the skills to help you there. But in my case, what I try to do is help focus on how to grow your wealth. And one thing you said that has always been said by most people is that cash is kind of your lowest risk investment. You're going to leave that at the bank. You're going to get a low return, but it's low risk. What I teach in my course is that actually it's very high risk. The risk is that you're not going to have money when you need it when you retire.
Mm.
And if you need £1 million to retire comfortably, as an example, and instead, because you put your money in cash, you only have £200,000, that difference of 800,000 is the risk that you expose yourself to. It's called shortfall risk. Nobody talks about it in the financial world because who cares? No advisor is going to be there 30 years from now to realize, oh, sorry, I gave you the advice to hold cash. Now you only have 200,000 instead of the $1 million that you need. Nobody's going to be there. It's only you that must take care of your own wealth, you know, and understand these things. Yep. Yeah. So Hannah too says, I've been on the Vanguard site. Yeah, it can be overwhelming. Sometimes they have a hotline. I know in America they have a hotline. But I would say the first thing you have to do is try to open an account. If you open an account, you don't have to buy anything. You just put money into an account. That is cash sitting in an account. it could take you 6 months before you feel comfortable to actually take that cash, call Vanguard and say, okay, I want you to take the cash and use it to buy the VT fund. So just focus on opening the account first, not then don't worry about what you're going to put it in. That's my advice, is one way to make it simple.
Yeah. Thank you, Andrew. And maybe I can do a little tutorial video on how to do that for you, Hannah, too.
I think we got a lot of homework, huh?
Yeah. I'll make a note of that. I'll do a little tutorial video for that, in addition to the cheat sheet that we're going to do. I'll send that out. Don't mind me. I'm just writing it down so I don't forget. Right. Okay, great. So, wow, we have spent so much time, and I know you guys have like a busy Saturday. If you have any other questions, please drop it in. There's so much that we can cover in such a short time, or there's only so much that we can cover in such a short time. So if you have any other particular questions, someone mentioned about saving for their first house. I dropped a link there on my blog where I shared about how you can, do that. There, at the time there used to be the Help to Buy ISA and the Lifetime ISA, and you can invest via those with those vehicles and use that towards investing in your first home, towards investing towards the future or your first home. And I think I explained that on that blog or a different blog on my website. So if you have any other questions, please drop it. Based on our knowledge, we'll share what we can with you. And okay, one more. What are your thoughts on new platforms like Robinhood investment platforms?
I wouldn't focus on Robinhood because it's basically for buying stocks, and you probably shouldn't be buying stocks. You should be buying funds. So I would go for a Robo Advisor before I'd go for Robinhood. But that's not, it's a hard one to answer, but that would be the first pass on it. I'd say just avoid buying stocks for right now. Buy funds.
Yeah, just to add on to that, if you want to start, I don't do stocks anymore. I used to, but one thing that you need to do is get some knowledge. You need to get some knowledge on and do some research on what stocks you're buying, the companies you're buying in, who the CEOs are, and those kind of things. So it's not something that you should just, do. I'm not saying that you shouldn't, but you should. Okay, Help to Buy ISA still available? Yeah, probably it's not. But I think the Lifetime ISA is. But yes, definitely get some more knowledge, do some research if you want to use like Robinhood and start and investing in single stocks. Definitely do that, because that is something that I did, and I can tell you that whole story in different times. So Andrew, like for people who want to learn a bit more, like what can we do for them? I know you've got a great gift.
There's a couple things. Yes, there's a couple of things. The first thing is I have a podcast. It's called My Worst Investment Ever. Go there and listen to the stories of loss, and you will learn a lot. The second thing is for those people that do want to actually, get into the detail of how you can understand this stuff. Basically, I'm going to paste into the group my link to my course. And what I've done is there's a link. The first one that's called a direct link should go directly to the course. What Elizabeth and I talked about, it's giving you guys actually a 60% discount on the course. The course is normally $197. So it's like crazy cheap. So you can go to the course and sign up. It's 100% money back guarantee. So even if you did 30 days or 29 days, it's 30-day money back. And then you told me that you didn't, you don't want it, you want it out, I would refund your money. So don't worry about that. So that's the first thing that you could do. The second thing is you say, look, I don't want to spend any money on that right now. And then what I can do is I do have a free course where I go over these investment terms. And for some of you guys, that may be a place that you could start. And so let me just pull that one up. And
yeah, I can drop it in for you.
Okay, if you can drop it in.
So I'll drop in the free course, and that's the gift to everyone.
Yeah, so the gift is just take the free course. It's the 40 words that are in the course. if you find it, if you really have a hard time with it, it may be that the course is going to be super hard for you, but hopefully not. So I think that's the main thing. And you guys can get a hold of me, if you go to, actually, if you have any questions, I think the best way to do that is go to Elizabeth, and then she and I will kind of bring in the questions together, and then we'll try to respond, and maybe we can do another thing. We can either do it by recording or the like. And so I'm going to have to run, but I want to just thank Elizabeth for making this happen. And I also, I have a little thing. I teach executive MBA here in Thailand, and I have about 35 students in my class, and I see we got about 44 people on right now. What I always do is ask my students to turn on their video if they're in a reasonable situation. And so as a way of saying goodbye, I got my screen on big. So if any of you guys feel comfortable, turn on your screen. It's a great way to just see everybody's faces and enjoy the moment before we end this call.
Yeah.
And that's awesome to see you all. That's great.
And if we could just do one thing, drop in the chat, like what you learned or what you're going to do, what your next action step is going to be. Like what you learned or what your next action step. Because one thing that happens is we learn so many things. There's so much that's going on, and we have to go away and like do some research to learn something more, but we don't write it down, so we don't actually like take action. And drop it in the chat. I want to know, because then I can like send you a message, send you an email asking you in like a couple of weeks, how was what you did? Did you check the free course? Did you have a look at the offer? He's giving 60% off, and the actual course is about $197, and this is dollars, not even pounds. So it's like if that's what you want to do, if you want to go and look into Vanguard, just to research it. If it's crowdfunding that you want to do, and you want to do a bit more research about what that involves, if you're looking at creating more wealth for yourself, and you're going to think about how you can increase your personal value, how you can increase value for your company or value for your own business, and how you can then, start growing your wealth in a way. Maybe you want to actually Google compound interest calculators and actually put some numbers in and see how much you need to be investing each month at 8% as a rough figure to see how much it will grow per month. And like literally just Google compound interest calculator and just put some numbers in. Maybe you want to check out that what the UK government offers with regards to helping new first-time buyers to buy their first home. I know that there's the LISA, and at the time I wrote my article, there was the help to buy, but maybe that's changed now. So you can, do some research with regards to that and see how they help you with your money. And thank you, for everyone who has dropped something.
Yeah, that's a great comments that everybody's made. I think, one of I would summarize from what I'm seeing is, go to the Vanguard website, look at the VT fund, ask some questions, look around, try to understand what would it take to open an account. And you don't have to rush. Take your time, take it step by step. I'll make myself available to Elizabeth to help you guys to think about that. But I want to leave with one last thing, because I know that somebody said the idea of next action for me is to think of more ways to create wealth. That was Yuande. And I just think that this is a great one to finish on. And that is, I live in Thailand, and I worked in the financial industry in Thailand, and I made great money in Thailand. But one of my friends said to me, why don't you go to New York? Your salary would be, 10 times what you're making in Thailand. And I said to my friend, yeah, but my cost would also be 10 times. You see, in Thailand, if I make $100,000, I can live on 20,000. It's the gap between our income and our cost that really creates the wealth. And so I really challenge you all to think about things that you can do to make sure that you're keeping your cost deeply below your income, and take pride in that, and don't let society pressure you into feeling like you've got to spend and spend. And that's a lesson I learned. We all learned it from our parents and people around us that told us that. So that's awesome. All right.
Great. Thank you so much all for coming. It's gone it's gone way past. And thank you so much, Andrew. Thank you, everyone, for showing up and staying all the way to the end. If you have any questions for myself or for Andrew, send an email. Not because we're closing now. Send an email. We're going to put together a cheat sheet. We're going to put together a video, so like we can do that all at the same time, right? And so send it as quick as you can. So great. Thank you so much. Have a great Saturday. And I'll see you guys all on my next masterclass, which is coming up soon. So look out your emails. Okay. Thank you. Bye.
Thank you. Bye.
Bye.
Bye. Thank you.
Thank you. Thank you.
Thank you.
Bye. Thank you.
Bye. Thank you.
Thank you.